Peter, that is a trifecta of trouble for equities. Multiple compression, revenues perhaps slowing, and profit margins getting squeezed.
Hi, Tyler. Well, those are the three drivers of equity prices at the end of the day. It's what the PE multiple is going to end up being and where do earnings go. And we know through rate hikes, interest rate increases, and quantitative tightening about to begin, we've seen this multiple compression that really started last year with the most expensive parts of the market. Now on the E side, the earnings side, well, we're now seeing profit margin compression. We heard that writ large this week. But keep in mind that profit margin compression is coming off near record highs. So there's a lot more room potentially on the downside. On the revenue side, now we're obviously worrying about the economic downturn and slowing rate of growth as we progress through the year, particularly in certain parts of the economy. So that's what gets to this perfect storm of compressed multiples at the same time have earnings at risk.
I don't want to linger on it and make this the point of our conversation today, but wouldn't one rather have profit margin compression when profits were high and margins were high than when they were low? I mean, so in other words, I'm trying to turn the argument inside out a little bit.
Well, the one challenge with that is you're trading at 17 times earnings right now, even with this pullback in the market. And that 17 times earnings estimate is embedded with record high profit margins.
Right.
So if you see a reduction in earnings estimates and earnings that are eventually realized at the same time you're seeing this PE multiple compression, that's the toxic combination.
Peter, Jeremy Grantham last hour when we spoke said he would recommend resource names. He actually recommended climate change plays, basically thinks that that's going to be one area that does see huge top line growth in the decades you could call it ahead. Commodities are notoriously difficult to invest in and can be very fickle over time. But I know you've been a fan of this kind of trade as well. Can you give some people some specific ideas? I mean, should they buy companies, or are these names looking too crowded, or could energy have another couple of years to run? I mean, Pioneer today said they think oil is going to be over $100 a barrel for a couple of years.
Right. Energy stocks, I still think, have room to go, particularly the European oil stocks that are barely above their pre-COVID levels. And the group as a whole, as part of the S&P 500, is only about 5%. Which, while that's twice as much as where it bottomed out at, I think that ratio is going to go higher. So it's one of my highest conviction ideas, and I remain very bullish on precious metals. I just think it's a safer place to be in this very uncertain environment. Gold and silver, and you can buy that through ETFs or you can buy the individual miners. And with energy, I'd be buying the companies as opposed to speculating in the futures market on the actual price, which I do think will go higher.
What would you say about the S&P 500 broadly right now?
Well, as I said to Tyler, 17 times earnings on near record profit margins, I think, is a risk. I think the PE multiple continues to compress, probably something 15 or less, with quantitative tightening and interest rates going up at the same time that earnings estimates I expect to fall as the year progresses.